When we look at another relative valuation method, the enterprise value to EBITDA ratio. Your enterprise value is the market value of your common stock plus the market value of your preferred shares plus your market value of debt plus your minority interest, and then you deduct your cash and investments from that. So your EBITDA is your earnings before interest, tax, depreciation, and amortization. So if you want to work out your EV/EBITDA ratio, you have to divide your enterprise value divided by your EBITDA. And this ratio indicates the value of the entire company, not just the equity. The advantages of the EV/EBITDA ratio is that it's more useful than your price-earnings ratio when you're comparing companies with different degrees of leverage. Earnings before interest, tax, depreciation, and amortization. So if you want to work out your EV/EBITDA ratio, you have to divide your enterprise value divided by your EBITDA. And this ratio indicates the value of the entire company, not just the equity. The advantages of the EV/EBITDA ratio is that it's more useful than your price-earnings ratio when you're comparing companies with different degrees of leverage. It's also useful for valuing capital-intensive companies that have high levels of depreciation and amortization. So if you look at capital-intensive companies, that could be like an Equestra, that's got a mining division that is highly capital intensive. Some of the construction companies are highly capital intensive. And again, your enterprise value EV/EBITDA ratio is usually positive when your earnings per share is not positive. So again, it's useful when you cannot use your PE or your PEG ratio. The disadvantages is if working capital is growing, your EBITDA will be overstated in your cash flow from operations. And again, it ignores different revenue recognition policies. So if you account for your revenue differently, it makes comparability very difficult. The interpretation of the EV/EBITDA ratio is that a low ratio could indicate that a company is undervalued, and therefore a high ratio could indicate that a company is overvalued. So now that we've looked at relative valuation, let's look at an example. So we're taking the big four construction companies, Wilson Bailey Homes, Murray & Roberts, Avenge, and Group 5. And we are going to apply our different relative valuation metrics on these companies to see which of those are undervalued or overvalued compared to the industry. So if we calculated we got the share price, we got the current PE, the forward earnings per share, the forecast earnings per share, you can get easily from data providers like Bloomberg or iNetBridge that normally pull consensus forecasts from different institutions, from the different brokerage houses. And then we can work out the expected growth rate, your forward PE, your PEG ratio, and your EV/EBITDA, as well as your price to book ratio. So looking at the results, we look at a forward PE. Based on the growth that we're forecasting, we're seeing that Wilson Bailey Homes forward PE will go from 11.84 to 10.1, whereas Murray & Roberts is expecting more growth, earnings growth, so they go from 11.02 to 9.46. Avenge's expected growth rate is over 100%, so they go from a current PE of 20 to a forward PE of 9. So we see that there could be significant re-rating, that they could be more profitable going forward. So based on the forward PEs, we would say that Wilson Bailey Homes would be the most expensive, and Murray and Roberts looks like they would be the cheapest based on the re-rating. When we put the PEG ratio, which is pretty much just using, so your forward PE is your price divided by your next year's EPS, and your PEG ratio is the current PE that you have divided by the growth. So that is the EPS growth rate. So there we see that Avenge looks the cheapest because it's got the lowest PEG ratio. Your EV/EBITDA method, again, shows that Murray and Roberts is the cheapest. And your price to book value shows that the low price to book value shows that Avenge is cheaper. So then we can go down and look at the companies, look at the ROEs. And if we go back, we can see we were looking at a company that's got a low PE, a high ROE, low risk, and high growth opportunity. So if we look at the ROEs of these four companies, we can see that Avenge's ROE is very low. So that could give us conflicting information about what the valuation on that company is. So whereas Murray and Roberts has got a decent ROE of 15%, it's not the highest, but it is quite substantial. So we must look at all these metrics together before we make up our minds about which companies we see on a relative basis are over or undervalued, because one metric might give us a negative signal, a wrong signal, which could impact on our decision as to whether a company is under or overvalued. That is all that we have for today.